Chapter 7's next objective is to apply internal controls to cash receipts. We looked at internal controls with respect to the cash account through the bank. Now let's talk about cash receipts. Cash receipts can be received two ways from a business: over the counter or by the mail. Cash receipts over the counter, a good system of internal control will have a receipt issue for each transaction. The cash drawer should open when a transaction is entered, and the register should record the transaction on a slip. At the end of the shift, the manager, someone other than the cashier, should prove the cash between what was started out at the end of the day versus what the cashier finished up with, and to prove it against the tape on the machine. What does this do? It prevents theft. At least once a day, the cashier should deposit cash into the bank. That means that when the cashier gets too much cash, they should give the cash to someone, or to drop it in a safe. And then at the end of the day, the register tape should be sent to accounting department to support the day's transactions. So that's those are some examples of internal controls for cash receipts over the counter. For mail, receipts received by mail, the mailroom employee should open the mail. Okay, checks are then sent to the treasurer, and the cashier should make the deposit. A remittance advice should be sent to accounting in order to make the journal entries. So the cash is going one direction, and the remittance advices are going in another direction. Okay, checks going this direction, and the remittance advice is going in this direction. The controller then, at the end of the day, should compare the amounts that were deposited versus the debit to cash that was made by the accounting department. So that way, we're comparing each flow of information, and they should be able to be easily reconciled.